So let's talk about kids. And in this video, I'm going to go through my thought process for private school. So I got a couple of things here, a little story to share with you. So let's get started. So recently I came across an Instagram video that says instead of putting $60,000 a year for private school for your kids, you should just take that $60,000 a year and put it towards investing. And I thought that was very interesting because he was saying that by the time he's 30, on average S&P 500 compounds 7% a year, he will have $5 million. So even if he has gone to public school and he didn't turn out to be the amazing doctor, engineer, accountant, lawyer you wanted your kids to be, he'll have $5 million by 30 and he'll be in a pretty safe position. And I thought, wow, that's that's quite interesting. And I looked at the comments, and then people are like, where do you find private schools that are $60,000 a year? And turns out it's New York and California as well. So just showing you the New York average private school cost is around $65,000 a year. Okay, so that is our starting point. And in this video, I'm going to analyze what are the possible scenarios in terms of wealth you're passing on to your kids. What are some of the key topics I want to teach my kids about? Whether that is school, whether that is money or investing, and a little bit about my story on how I came to be. So let's start with my story. So if you have been following me for a while, you know that I have a bachelor degree in accounting from UBC, and I also have a master's degree in accounting. And if you look at my family history, my parents are actually taxi drivers. They're not very educated. They sell fruits, even though they are selling fruits in one of the most popular area in Hong Kong. So then they made a decent living. And my mother's education was at the primary school level. So they spent a fortune trying to get me educated. And Lord and behold, I've gotten a university degree and also a master's degree. And that is really because they value education. And using this education, I was able to become an auditor in KPMG. I was able to lead and develop a data analytics team for KPMG in Hong Kong. And I also got my CPA and my chartered investment manager license. So now I'm in the process of starting a hedge fund. So my life has changed drastically because of education, because of all these professional designations I pursued. And this is all thanks to my parents and their willingness to invest in education. So right now I have two kids, and this is what I think about, is whether or not I should send them to public school versus private schools. Now, in certain countries in the world, the public school system is horrendous, and there's really no point in going through the public school system. So then all the kids that can afford it go to private schools so they can eventually get to a good university. Now, it's not the case in Canada because we actually invest in education, and I have gone through the public education system in Hong Kong, Calgary, Vancouver, and I think the public education system is fairly decent. So let's do this scenario analysis for $60,000 a year. Now let me jump over to this side. So here I have a compound interest calculator from investor.gov, which is by US Security Exchange Commission, if that is in any significance. And basically it calculates how much the investment would be worth if we invest $60,000 a year, which is $5,000 a month. So we put that initial contribution, the first 10 years of the kid's life. Now I can extend this up to 18 years of the kid's life, but I think 10 years is more than enough to demonstrate my point. So then the estimated interest rate is 10%. I rounded this up slightly because for the last 10 years or so, S&P 500 on average is making around 10% instead of 7%. The 7% figure is more like a 30-year average. So here you can see that in 10 years, you will have 950,000. And this is where I want to stop contributing and just let the capital continue to grow by itself. So then the second part is that now you have $1 million by age 10 of the kid. Invest for another 20 years with zero contribution. And then the interest rate is 10%, basically just S&P 500 here. And in 20 years, you're going to have 6.7 million to pass to your kid. And that is a very powerful concept because you got to think the private school you send your kids to, it's got to be worth 6.7 million by age 30. So if you look at the 30-year-olds today, I'm a 30-year-old today, having 6.7 million immediately cash, I think that is very powerful. And if he learns the right investing techniques, if he learns the right way to manage his money, properly allocated, he can invest in a couple of startups, private equity, buy a few businesses, and then the rest in S&P 500 and do extremely well. So if you think far ahead enough, and if you're planning to fork out $60,000 a year for your kid for private education anyways, then you might as well invest it and give him 6.7 million in 30 years. Now, an interesting thing is I do know some people that prefer private education because they want to get connected with other families that are also ultra high net worth. Because if you're willing to spend 60K a year on your kid's education, you're going to be at a certain level of wealth, which if you are connecting with these people and if your clients are in that area, then it totally makes sense to do so. It's like, why would someone drive a Lamborghini and to meet other people who drive Lamborghini and then lead to more business? Same idea. Now, an interesting thing I wanted to do is what if I invest $60,000 a year for my kid, but then instead the interest rate or the growth rate is 20%. So historically, on average, I aim for around 20 to 30% return a year. So I know that a 20% return is achievable. And if you look at Warren Buffett, he makes around 20% a year anyways, relatively conservatively. So if I just put everything into Berkshire Hathaway instead of S&P 500, I'll be at 20%. So it's not that unrealistic to have a 20% growth rate. And for example, the early investors into my business investing accelerator, the target dividend is 20% cash. And the hedge fund and the mutual fund I'm planning to start, the target return is 20% as well. So it's interesting to know if you have invested 60K a year for 10 years for your kid in investing accelerator, mutual fund or hedge fund, or Warren Buffett's company, what would happen? So in 10 years, it's going to be 1.5 million. So this is actually not that different compared to the 950,000. It's 50% more, yes, but to be honest, it's not going to move the needle, meaning that if I need to take a lot more risk to make 20%, I don't really think I need to go through the trouble to do so. But what about the next 20 years? After you leave it alone, you have $1.5 million to start, no more contribution, the length of time is 20 years, and the growth rate is 20%. By the kid is 30, so 20 years after 10 years old, the kid will have $57 million. And this is the real power of compound interest. And compared to 6.7 million, which was only making 10% a year, versus 57 million. So 57 million, it's enough to start a fund on your own. Like the fund I'm trying to start, the hedge fund and mutual fund, the minimum requirement to start is 50 million. And if you make 20% a year for 30 years, you have 57 million. by saving 60K a year. So I think that is very interesting. And right now, I'm not putting aside 60,000 that much because I have all these other projects I'm investing in. But my wife and I each contribute $10,000 per kid per year. And based on my calculation, my initial thought is that using my investing strategy, making 20 to 30% return a year, and if I do this for the first 5 years of the kid's life, then it would cover the tuition and potentially buying a house when he's old enough. So it should be somewhere around 300 to $1 million when the kid is around 20 years old. And I think this example of where you let the money grow until the kid is 30 years old is much more interesting because you can see the compounding effect for the last 20 years at 20% is quite significant. So if I'm making, let's say, 25% a year for the kid, then obviously this will be even more powerful because the compound rate is so much higher. So that means if I'm putting aside $60,000 a year for the first 10 years of the kid's life and invest and get 20 to 30% return a year, this will basically change the category of wealth he's in from, let's say, a decent middle class to maybe upper middle class, per se. And I think that would be a very good starting point. But then there are also a couple of concerns. So, first, some people argue that you don't want to give your kids that much money because you want to let them learn how to survive on their own and develop these skill sets, so on and so forth. That's the first concern. The second concern is there's an idea of the pursuit of happiness versus the happiness of pursuit. So, one is that some people reach a goal because once you reach the goal, you become happy. And the second one is that as you become the person you want to be, you are on this happy journey. And this is a little bit more philosophical compared to just calculating the compound interest and how much money you'll get in 30 years. Because if you just give the kid, let's say, $50 million, you essentially solve most of the challenges for this kid's life. Basically, you give them money to buy what money can buy, but you cannot give them money to buy what money cannot buy, which is also another complicated topic we'll talk about in the future. So I think outside of just giving the kids money, I also consider what is the knowledge or characteristic I would like to pass on to my kid. Now, one of the things is financial freedom. That's what I talk a lot about on this channel, and that's what I think about a lot as well. And if you join the community that I have for free below, Invest and Retire community, it's all about financial freedom. And over the years, I've seen a lot of people making a lot of money, some people not so much, and some people retiring, some people have to delay it. And basically, what is financial freedom? And I think financial freedom is not necessarily a set number. It's not 1 million, it's not 5 million, it's not 10 million. I don't think you become free by reaching a certain number. I think you become free when you have developed the ability to make money with as little effort as possible. So let me explain. Let's say I give you $1 million and you instantly become a millionaire, which is great. But then you don't know how to invest. So you only invest in bonds or guarantee certificates. That gives you 4% a year. So that's only 40,000 a year. That's barely minimum wage. So if you don't plan to draw down on your $1 million principal and you make only 4% a year because you don't know how to make money using money, that's not really financially free. That's just the minimum you need to achieve to become independent. And you still might keep your job because what are you going to do with all this time and $40,000 a year? So let's say you learn how to make money. Okay, you learn business skills, you learn how to run a business, you learn how to be a developer, you learn how to invest in the markets and get 20, 30% return a year. So with $1 million, you can make 200 and 300,000. With $300,000 alone, you can make, let's say, 100,000. So you can see, by knowing how to invest, knowing how to build a business, you have the ability to make money. And that in itself is freedom. So obviously, me, I teach people how to invest. So I'm going to be teaching my kids how to invest as well. Because once you know how to invest, there's a sense of freedom, because I know that in 30 days or 45 days, I can make money with the monthly passive income strategy. I know that if I want 10K a month, I just need to use 300,000, make 3 to 4% a month. That is 10K a month. In essence, once someone reaches, let's say, 300,000, and you know how to make 3% a month, that is 10K a month, you are financially free. You don't need to reach for a crazy goal to save for 1 or 5 or $10 million and only take out 4%, because you are unable to manage that money wisely. So then you got to go for the riskless, lowest return product possible on the market. Now, of course, there's nothing wrong with having $10 million. So if you have $10 million, you would put 1 million towards monthly passive income. That gets you 30,000 a month, 300,000 a year. And then you put the remaining 9 million towards S&P 500, and that gets you 900,000 a year, which is 1.2 million a year. So that is not bad. So what you really want is to have the amount of capital you need to generate that return, because 30% return of nothing is still nothing. So you need to start with, let's say, 300K. That's a good starting point. And most people retire with 300K, in my opinion. And then afterwards, if you have more money, it's just a matter of diversifying. So with 300K, you use the monthly passive income strategy, making 3% a month. That requires knowledge. It requires you to select individual monthly passive income trade. For me, I do one trade a week to generate that 10K a month. And then anything excess should be all long-term investing. Certain indexes, or Berkshire Hathaway, or like big tech stocks, or like certain indexes that gets you around 20% a year to 30% a year. That's what you need. So we talked about the capital part, which is the amount of capital you want to pass on to your kids so that they are living a good life. But there's also the knowledge part, is how do you handle that money to make money? And if you know how to do that, you actually don't need that much capital. Okay? So you're still with me so far, then we're going to talk about the next part. So now you give them some basic investing skills. You give them a good portfolio to start with. I think what's really important then is, what is it that they want to do? Or what kind of change they want to create in the world, and creating value in the world. And I think that is very important. And using the word value makes it a very businessy or economic-y concept. But I think in the world where we have rapid improvements, we have AI, I think it is important to learn how to create value, which is basically how to help people solve problems and be a good person in the world. So ultimately, it becomes a very character focused development. So you have education, you have knowledge that gives you skills, but then it doesn't determine who you want to be or who you are becoming. And character, someone who's a good person, someone who's a trustworthy person, it's not something you can buy with money. It's something that requires education and communication and patience. And I think that is really where I want to get to when it comes to my kids, is not so much to just give them 1 million or 10 million or 50 million in 30 years, but the ability to make money, and the ability to, let's say, develop a business, and also the character of who they want to be and who are they becoming. And I think if I'm able to address all three of them at the same time, I think I would have achieved my goal. and I've done a good job. I'm very grateful for my parents investing so heavily in education, and through all the years of communication, they also invested heavily in character development, which is not something money can buy. And that is extremely crucial because the decisions you make comes from character. It doesn't necessarily come from how much money you have. And the character type decisions are ultimately going to change the path you go down in your life and how you think about the world as well. So for this part of the video, I want to talk about S&P 500. So here you see that for February 21st this week, the market is actually overall down. And on a daily basis, you actually see a very large candle on Friday. So on Tuesday, Wednesday, Thursday, the market really didn't move. And on Friday, it dropped significantly. So I want to go through why. So here's the article on Bloomberg. US consumers' long run inflation views rise to the highest level since 1995. So here you can see it. And basically, the long term inflation is expected to be 3.5%. So previously, before Trump took office, we're in a very stable economic growing environment. And then with the latest potential tariff, inflation is starting to come back. People are getting scared of rising costs and also reducing trade globally between US Canada, between US Mexico, and US Europe as well. So then they're expecting a 3.5% inflation going forward. And what does that mean? It means that Fed is in no rush to lower the rates. That means we're going to encounter higher rates for longer, and that's going to hurt the real estate sector, obviously. And they might even increase rates to further bring down inflation. And I think that's really the worst case scenario, is that they increase the interest rate to bring down inflation. So we'll have to wait for next Fed speech, but that is why the market has gone down slightly. Now, overall, my view for S&P 500 this year and also the technology sector is actually bullish. So usually during these opportunities where the market suddenly drops significantly for a week or two, that's when we want to be buying in to your favorite stocks when they're at a discount. So some of the ones that I'm looking at right now is Microsoft, which is a no-brainer. And let me just bring up the chart. So I've been talking about Microsoft for a while within Investing Accelerator, and with its open AI momentum, its ability to offer cloud services for various AI models, and historically, Microsoft goes up by around 20 to 30% a year. Right now, it is actually at a discounted price compared to the other big tech. So then it's just a matter of time before Microsoft goes up again. So right now at 408 is actually a fairly good buying opportunity. So students within Investing Accelerator have been looking at this stock. And if you're interested, you can look at Microsoft as well. And you'll find that's relative to the other big tech stock is at a discount, as it is slightly lagging behind in terms of price compared to Apple, Meta, Amazon, Google. So when it comes to growing a business, it's all about resolving the most crucial bottleneck right in front of you, so then your business can continue to expand. So if you have been following me for a while, I have been expanding my business over the last 12 months. So in this video, I want to share some of the progress, the key bottleneck I'm resolving right now, and if you have any additional ideas, feel free to let me know as well. So for Investing Accelerator, it is an educational coaching program where I teach people without any financial background how to invest and how to generate retirement income on a monthly basis using advanced investing strategies. So before I start raising capital, I was making around $25,000 a month in terms of tuition revenue. So that is fantastic. And then after I raised capital in 2024, I was able to scale that business to $75,000 a month by the end of the year, 2024. Now, The capital being raised has a couple of purposes. So the first one is obviously to expand the existing coaching program, and the other purpose is also to expand the offering. So right now, I'm stepping into the portfolio management space, and eventually, I'm going to be opening my own investment capital firm underneath this parent company and basically starting my hedge fund and mutual fund in US and Canada. So that's what the early investors are investing in, and they're getting a high return of a target 20.5% dividend. So now we're at 75,000 a month end of the year. So in early 2025, I continue to raise capital, and as of February, we are on track to making 150,000 a month. And this has a combination of revenue in terms of the strategies I'm using internally for investing and also the education coaching program. So that's what we're at. And we're not even done Q1 yet, so this is a projection. So far, the amount of capital I've raised is 1.5 million. And in the next couple of months, we should be able to raise another 700,000 with other investors coming in on board. So then that means the capital raise will be 2.2 million by the end of Q1. So that capital will be put to work immediately. So then going forward in Q2, I expect the monthly revenue to be around 250,000 altogether. So then that is great. Now here is the bottleneck I'm working on. So with a 250,000 a month revenue, this will lead to approximately an annualized 2.5 to 3 million revenue. It sounds like a lot, but it's actually not enough to reach a certain threshold to unlock the next stage of growth. When it comes to raising capital, we can raise a couple of million from people network, my email subscribers, YouTube subscribers, and whatnot. But then once you need to raise something like 50 million, this is a much larger amount, and you need to start approaching some of the more professional investors like venture capitalists, private equity, and family offices, and so on. So, after speaking with quite a number of them, what I find is that they would prefer a much stronger track record, and also the company right now is too small to approach these institutional investors. So then I did a lot of research and trying to figure out what is the threshold I need in order to approach these private placement agents, which is like a group of people that will help you fundraise. And usually they're like investment bankers, and also approaching these institutional investors where this deal is large enough to interest them. So the answer is 5 million a year in terms of revenue. So then right now, if we're on track, then by Q2, I'll be at around 2.5 million in terms of annualized revenue. So that means if I raise a little bit more capital from a couple more investors, then that will get me to the 5 million a year threshold within the next 2 years. So that will allow me to unlock and work with multiple private placement agents. And then that will have enough track record to attract these institutional investors. Because obviously, a 20.5% dividend is very high, it's very attractive in the investing world. So the only thing that would hold them back to invest is they don't know me well enough, which makes total sense given that I don't have an extensive network of these institutional investors. And second, I don't have a strong enough track record yet to prove to them that they can get this dividend. So that's what I'm going to be working towards in the next 12 months is to generate that track record and continue to raise capital from accredited and professional investors that know me and like me. And then once we have enough capital and track record, then we can go for the institutional investors and further accelerate the progress. So that is the key bottleneck I'm working on right now. And if you have any ideas on how I can speed that up, let's say by 6 to 12 months, feel free to let me know. So for this part of the video, I just want to spend some time with you and explore a topic I'm interested in, which is related to politics, old age security, social security, and what's going to happen in the next 4 years to the next 10 years. Now, I think it is common knowledge that Social Security will eventually run out as the boomers retire, and then there's a smaller population of the working class, like the younger folks, millennials, Gen Zs, uh, and then this will lead to depletion of the Social Security, and based on this article, will lead to higher poverty among older adults and people with disability. Okay, so basically, the Social Security Trust Fund is projected to run out by 2035, and today is 2025, which means the next 10 years. Now, interesting thing is that after Trump took office, within 30 days, Elon Musk went in and audited the Social Security database with a bunch of computer science people instead of auditors, like CPA or myself. And then they call it is wrong, a bunch of like fraudulent people over than 100 years old is receiving Social Security, so then they want to cut it. And whether or not it is true, which it is not because they got the date wrong and they did the math wrong, whether or not the claim is true, we can see the intention is that they want to cut Social Security, so then there will be more tax cuts provided to the corporations and the billionaires. So it's quite straightforward on what they're trying to achieve. And what I'm interested in exploring is how did we arrive at the situation today? And what caused the vote to change per se? And that's what we're going to talk about. So as of the time I'm recording this video, they haven't officially cut it, but cutting Social Security only speeds up this issue, is that the trust fund is running out in the next 10 years. So if we assume that Republicans will continue to have control over the next 4 years, and then they win one more election, that's 8 years. So basically, by the time the Republicans are done, the Social Security Trust Fund will run out, and if they cut it, it'll be faster. So it's quite straightforward. So let's look at the population of the United States by age in 2025. So on the left-hand side, you see the age. And here you can see that the boomers, which is 65, 60, 55 here, this is a large percentage, which is moving towards retirement. And then you can see that it becomes a lot smaller in terms of the age distribution, mainly because the life expectancy of the United States is around 75 to 80 years old. I think it's 79 last time I checked. And in here, you can see that with this large population, there's a large working group here between 25 to 40, which, if you actually look at this, is actually sufficient to support this older generation from retiring, hopefully. Now, let's talk about who needs Social Security, because I think that's actually quite important. Now, from my research here, for this article, the name is that people of color and Social Security, 40% of Hispanic, basically Latinos, rely on Social Security as the sole source of income. 33% are African Americans, 26% Asian, and then 18% white. And this is actually what I expected as well, is that people who voted to cut Social Security are the ones that need it the least. So then if your income is high enough, the Social Security aspect of it is not really going to help you with retirement. So in other words, you're contributing to all this money over time, and then in the end, you're not really the one benefiting it. So that is a key observation. So just remember Hispanics first, and then African Americans, and then Asian, and then finally white. So basically, white people rely on it the least, and it's mainly because their income is higher. So then here, people of color generally earn less than white, and they benefit more from Social Security, which replaces a higher percentage of pre-retirement earnings for low-wage workers. So basically, people of color basically earn less money. Okay, so that brings me to the election. And how did we end up with this current situation? First of all, if you're a white person, then here you can see that you're mainly Republicans. And the first question is 57% supports Trump. So I think it does make sense from this perspective because only 18% of white people would benefit from Social Security. Now, before I continue and analyze the rest of the stats here, it's important to understand that this is not the only issue which makes someone vote for Trump versus Kamala, but I want to see whether or not certain people are voting against their own interests. So, for example, for Black people, they mainly voted for Kamala, and this is consistent if they do want or need Social Security. For Hispanic, this one is consistent, is in the middle, 51% Kamala. And then for Asian, here you can see that they're mainly Kamala as well, which may be other reasons, even if they don't need Social Security. Okay, so let's go down. Now, what's interesting here is when you're looking at the age group. So here you can see that's for 45 to 65. This is actually the most pro-Trump group. And then for the people over 65, they're actually very pro-Trump as well. And within the next 10 years, these two groups of people will be getting Social Security. Whereas for the younger generation, they wouldn't see their Social Security or the fruits of their labor until many years later. So you can see that the older generation actively voted for Trump, which eventually led to the cut of Social Security. So the reason why I brought this up is because today I saw a news article saying that the older generation, the boomers, are actually at their respective legislation halls, basically protesting to stop Elon Musk and Trump from cutting Social Security and Medicaid, so basically not cutting their health insurance, so on and so forth, which is why it brought me to this stats, because I want to see if they actually voted against themselves, which leads to this whole mess we're currently in. So if you're over 45, you're more pro-Trump. So basically, the people who are very close to retirement here, who will very soon need Social Security, are going to experience a decrease in Social Security. So basically, your Social Security benefit is getting cut. Okay, which is interesting, I say. Now, another interesting thing is here. In terms of education level, here you can see that if you're more educated, you're more likely Democratic. Now, if you have a college degree, chances are you're going to be earning a higher income than people with no college degree on average. It's not going to be true every single time. Like, people with no college degree can make a lot of money. But here you can see that if they do earn a lower income and they're more Trump supporter, then they're actually actively voting against themselves because they are the ones that need Social Security. Okay. Now, another interesting stats is the family income. So family income here, you can see that people who are making a decent income above 100,000, they're actually more Democratic. And then people who are making, let's say, average or up below average income, they're actually more Republican. And that is interesting because Republicans are about to cut the benefits that they rely on. So, for example, Social Security, Medicaid, and cutting those benefits will likely hurt them the most. Okay? This one is just interesting, I guess. Religion. Christians, Catholic are more Trump focused. I think it's mainly because of their abortion related policies. So we're in an interesting situation where we're arriving at a point where Social Security is actually useful to some people and not so useful to other people. So, for example, for Blacks, where their income is on average lower than whites, then the white people aren't actually benefiting from Social Security as much. And then for Latinos who are actually Trump supporters for this 45 to 64 age group actually benefits a lot from Social Security, but then they in the end voted against themselves. And another interesting thing is that for their income level, lower income individuals actually actively voted against themselves. And then the other one is people with a college degree are generally voting for, let's say, the greater good, versus people with no college degree ended up voting against themselves if they rely on Social Security. But it makes sense, doesn't it? Because if I'm a billionaire and I need to offer tax cuts to myself, then what I need to do is to convince a large group of people to vote for these tax cuts to myself. Now, of course, you don't tell them that you're going to cut their benefits to give tax cuts to yourself. So instead, you have all these other reasons to vote for the person, whether that is abortion, whether that is something else. So at the end of the day, the middle class people or college graduates are smart enough to vote for the greater good, whether that is more benefits, whether that is more regulation to make air travel safe. So then the billionaires are only a small group of people. So they need to use their money, basically advertising dollar, to blast these advertisements, propaganda, to convince the lower class people to vote for them. And I think that is really the main problem, is that you get different groups of people who rely on a certain benefit. And the key decision comes down to whether or not you can convince a specific group of people on your side, and in the end, they get hurt because the Social Security is being cut. Yeah, I guess that's just the way it is. And I guess that's where we're at today.